M&A to be done out there on Wall Street.
Indeed. Let's bring in David Molnar, who is a partner and also managing director, at the financial advisory outfit HighTower. $550 million in assets under management as at last count, AUM. He joins us live out of beautiful San Diego, California. David, good to see you and appreciate your time. So the deals that O was just talking about, especially the one for NCR, you know, we're seeing a noticeable pickup in activity, deal activity, M&A, ahead of the Fed hitting the liftoff, hitting the liftoff button.
Yep.
So I guess this is like what? Last chance before rates go up to do deals cheaply, or what?
Cheap financing out there?
Yeah, I mean, there could be a little bit of that going on, I'd say. I mean, I think right now we're in an interesting environment where, you know, growth is slowed a bit on the top line, and companies are looking for ways to stimulate share price and grow, then take that next step. And organic growth is difficult to come by in this economy, and so acquisition is the logical next step. There's a lot of attractive candidates out there, and so I think we're going to see, you know, many mergers. We've seen a lot. We'll see more to come, and interest rates certainly play a key role in that. And we want to lock in rates just like a consumer would on a long-term mortgage. If I can lock in long-term financing on an acquisition, I want to do it today.
Sure.
It's now getting too late, though. I mean, when you think about what the Fed's doing, we've got people talking about, earlier on today in the show, we were talking about the fact that rates could rise as early as July. Other people, of course, you know, analysts out there are saying not till 2016. Which camp are you in, and how quickly would you be moving if you're looking at these M&A deals?
Well, I'm probably in the latter camp. I'm not convinced that the Fed really has the clearance to grow. I think it's an interesting situation. They're really in a box. I mean, they desperately want to get off the zero bound because inevitably the economy will slow again, and the last place they want to be is a 0% interest rate on the Fed target funds at that point in time. So they need to raise rates, but at the same time, you know, the fear is if they raise them too quickly and then we have to reverse them because the economy weakens based on that, then they have to admit a policy error. So they're really trying to toe that line and figure out how to sort of get the market to allow them to move rates up a little bit without causing too much disruption. So, you know, you look at some of the data that's coming in, and it's mixed. We've had decent employment, but we've seen weaker industrial production. We've already talked about GDP and things like that. So I think that if we really go on the data, it probably implies a delay. It's not September, maybe later in the fall or even into 2016. They will do it, but I think September may be too early.
So David, here's the thing, though. Is everybody sort of getting a little too hung up on timing, though? Because, I mean, I think the consensus seems to be, and the conventional wisdom holds, that whenever they hit the liftoff button, look, it's going to be pretty much one and done, because from there on out, they're going to have to take it slow as she goes. That's one, because of uncertainties over not just the U.S. recovery, but the rest of the world. And two, because of what's happening in the rest of the world, in the Eurozone and also Japan, you know, they're continuing with their QE programs, and that is going to help the Fed in terms of keeping U.S. yields low or lower, no?
Yeah, I agree. I think the flip side, though, is that if we look at just the talk of raising rates and what it's done to the value of the dollar, and then what that has done to the economy domestically in the United States, is something that can't be discounted. So I think that there's concern there, is that, you know, if they start raising rates, and as you pointed out, the rest of the world is easing, that's going to bring money into the U.S. dollar. That's going to drive that up. It's going to hurt corporate earnings. It's going to retard growth. So, you know, there's again that box that I mentioned before, that it's, you know, if you raise and you send the wrong message, you know, then the market can get scared. And I think this Fed, more than any other Fed that I've seen in my career going back 20+ years, is so focused on what the markets will do and how they'll react. It's just a new world that we're in right now.
What's the money question here, then? Let's bring it back to that. Where do you put your money? If you are of the camp that you do expect rates to rise, which I think probably everybody would agree that's going to happen at some point in the next 6 to 12 months, rates are going to rise. Where do you put your money?
Right. Well, I mean, we come at it from the standpoint of we're quality, fundamental, long-term investors. So, you know, so I'll give you the first answer, the basic answer you'd expect from a wealth manager, which is be diversified, long-term. We're going to own quality stocks. We'll own some fixed income, and we'll own alternative investments. So I think those are the basic building blocks. I think what you do inside of that mix tactically is really how you're going to generate returns in this current environment that we find ourselves in. So for us, that's, you know, looking at the currency impact and avoiding areas areas that we think are going to be hurt by that. It's getting into, shortening durations in fixed income. We're looking at alternatives in fixed income that aren't so rate sensitive, and it's really owning quality stocks. And to Martin's point, QE in Japan, QE in Europe, we like foreign stocks a lot more than domestic.
Okay, so it sounds like you're looking for alpha uncorrelated returns there, it sounds like. So listen, real quickly, Dave, before we let you go, we got to talk about Greece there. Now, I understand that you believe that Greece and the whole Greek situation has outlived its usefulness for markets. What do you mean by that?
Well, we've been wringing our hands about Greece for 5 years now, and they've kicked the cans and had multiple bailouts every single time. So I don't want to say that I believe in central bank omnipotence. I certainly do not. But the ECB, the IMF, the Fed, they have put so much into keeping things together, and they're finally starting to get success in Europe. The last thing that I think that they're going to let happen is to let Greece spiral out of control and muck up the works. So I really think that all this stuff that we're talking about this week is political posturing. At the end of the day, somebody will blink and back down, the can will get kicked, and we'll be talking about this in 3 more months.
Oh,
Mark
great.
my words.
Excellent. Something to look forward to. David, thanks for that.
More Greek news.
More Greek
It's going to
news.
get dragged out further.
Brilliant.
Oh, my
Excellent.
gosh. Okay.
Thanks, David. We'll catch up with you in a few weeks again. All right, we're going to take a quick break, but let's bring up the next